Welcome back. In this second part of our introduction to fixed income, we turn our focus to the legal, regulatory, and tax considerations that affect fixed income securities. We start off first with understanding what a bond indenture is and discuss in detail the key components that are mentioned inside an indenture. After that, we shall discuss cross-border bonds issuance and its implications on the applicable regulations. We end off with a discussion on how income from bonds is generally taxed. Let's begin. In the last lesson, we've learned that there are three important elements that an investor needs to know when investing in a bond. They are the bond features, which include the issuer, maturity date, face value, coupon structure, and the currency of the bond. The legal, regulatory, and tax considerations with regards to the bond, and the contingency provisions. We shall discuss about the legal, regulatory, and tax considerations in this lesson. Let's first get familiar with some of the terms we're going to use in this lesson. The trust deed is the legal contract that describes the structure of the bond, the obligations of the issuer, and the rights of the bondholders. The trust deed is also frequently known as the bond indenture. The indenture states the basic features of the bond issue, which we have discussed in the last lesson. It is written in the name of the issuer and states the maturity date when the bonds will be repaid, the principal value for each bond, the coupon rate, and the dates the coupon rates will be made, the currency in which the bond is denominated, and whether the bond comes with any contingency provisions. As it may be impractical for the issuer to enter into a direct agreement with each of many bondholders, the indenture is usually held by a trustee. The trustee is typically a financial institution appointed by the issuer. Its role is to ensure that the issuer complies with the obligations specified in the indenture and to take action on behalf of the bondholders when necessary. It also ensures that the issuer makes timely payments to the bondholders. In the event of a default, the trustee is responsible for calling meetings of bondholders to discuss the actions to take. It can also bring legal action against the issuer on behalf of the bondholders. Besides stating the issuer and the features of the bond, an indenture also includes information regarding the funding sources for the interest payments and principal repayments, any collaterals, credit enhancements, or covenants. We shall go through each of these 5 items. The first item that a potential investor has to note is the issuer of the bond. Bonds can be issued by several types of legal entities, and bondholders must be aware of which entity has actually promised to make the interest and principal payments. We have, in the last lesson, learnt that there are 3 main sectors where bonds are issued: the government sector, the corporate sector, and the structured finance sector. Sovereign governments issue sovereign bonds. Sovereign bonds are most often issued by the Treasury of the issuing country. As national treasuries are big legal entities, there are usually no questions as to who makes the bond payments. Corporate bonds are a different story. A corporate bond may be issued by a company itself, by a subsidiary of a company, or a holding company that is the overall owner of several operating companies. Bondholders must pay attention to the specific entity issuing the bonds because the credit quality can differ among related entities. A bondholder of a subsidiary that defaults may not be able to lay claim on the assets of the parent unless the parent guarantees it. Likewise, a bondholder of a holding company may not be able to lay claims on the assets of its operating companies. Sometimes a company may issue bonds through a process called securitization. Such bonds are known as securitized bonds. This is done by creating a separate legal entity solely for the purpose of owning specific assets and issuing bonds to provide the funds to purchase the assets. These entities are referred to as special purpose entities or special purpose vehicles, and the bonds they issue are called securitized bonds. One of the key reasons for forming an SPV is bankruptcy remoteness. If the originating company goes bankrupt, the creditors cannot lay claim on the assets under the SPV. The SPV continues to meet its debt obligations for as long as its assets keep generating cash flow. For this reason, an SPV can issue bonds at a lower interest rate than bonds issued by the originating company. For example, company HelpMe has a poor credit rating and needs to raise $1 million. Investors are only willing to lend if the interest rate is 15%. Now, HelpMe has a pool of loans it has made to its customers. These are good quality loans in which the cash flows are sustainable. HelpMe could set up a special purpose vehicle based on this good quality asset. The SPV issues bonds to investors and uses the cash proceeds to buy the loans. The interest and principal payments on the loans are then used by the SPV to make the interest and principal payments on the bonds. Since the SPV and its assets are a separate legal entity from HelpMe, the interest rate of the bond will be based on the creditworthiness of the assets held by the SPV. Such an arrangement can help the company raise the $1 million at a lower interest rate. Another piece of important information stated on the indenture is the source of repayment proceeds. Sovereign bonds are backed by the full faith and credit of the national government. Therefore, the funding primarily depends on that government's ability to raise tax revenues and print money. Generally, sovereign bonds are perceived as the safest of all investments. This is because governments have the power to raise taxes to make interest and principal repayments. For corporate bonds, their source of payment is typically the company's ability to generate cash flows through its operations. As there are several factors that can affect the profitability of a firm, a company's cash flows can be highly unstable. As such, corporate bonds are considered more risky than most sovereign bonds. In contrast, the source of payment for securitized bonds does not depend on the operations or profitability of a company. It depends solely on the cash flows generated by the underlying assets. As such, investors should pay special attention to the quality of the assets backing the securitized bond. Collaterals are assets underlying a debt obligation, above and beyond the issuer's promise to pay. To illustrate, let's take an airline, for example. A typical airline may own assets like aircrafts, financial assets, and other assets like cash, equipment, and properties. The airline can issue secured bonds and unsecured bonds. Secured bonds are backed by assets or financial guarantees pledged to ensure debt repayment in the case of default. The pledged assets are known as collaterals. So the airline may pledge its aircraft as collaterals to a secured bonds issue. Such a secured debt is sometimes referred to as equipment trust certificates. Equipment trust certificates are debt securities backed by valuable physical assets such as oil rigs, ships, and airplanes. The airline may also pledge the stocks and bonds of other companies that it owns to another secured bonds issue. Such bonds, which are backed by financial assets, are also known as collateral trust bonds. In the event of a bankruptcy or liquidation of the airline, the secured bonds have a higher priority than unsecured bonds. This is because they have specific assets pledged as collateral. In contrast, the unsecured bonds have no collateral. The bondholders have only a general claim on the airline's assets and cash flows. Among unsecured bonds, there can be difference in priority. Unsecured bonds, which are senior, have priority over unsecured bonds which are junior or subordinated. So, for example, in the event of a liquidation, the amount recovered from the sale of the planes will be used to satisfy the obligations to the secured bondholders, and likewise for the financial assets. Any remaining amounts, plus the amounts recovered from the rest of the assets which are not pledged, are distributed to the senior unsecured bondholders. Any remaining amounts will be used to satisfy the junior unsecured bondholders. You may sometimes come across this term, debenture. Do be aware that the term is interpreted differently in different countries. For example, debentures refers to unsecured debt in the United States. In the UK, however, it refers to secured bonds. It is important for potential investors to review the indenture to determine whether a debenture is secured or unsecured. If a security is structured such that the cash flows from a particular asset are specifically set aside for payments to the bondholders, the security is known as an asset-backed security, or ABS. As we've learned earlier, the backing assets are usually sold to a separate bankruptcy remote entity known as a special purpose vehicle. If the originating firm goes bankrupt, the assets are protected from the originating firm's creditors. However, the relationship works both ways. If the backing assets fail to perform, the holders of the ABS have no recourse from the originating firm. In some countries, especially European countries, financial companies issue covered bonds. They're similar to ABS, but the underlying assets known as the cover pool remain on the balance sheet of the originating firm. This means that no SPV is created. Like ABS, the cover pool is bankruptcy remote. Special legislation protects the assets from the firm's creditors, even though the assets are in the firm's balance sheet. However, in contrast to an SPV, covered bonds also provide protection to their bondholders. If the assets in the cover pool fail to perform, the originating firm must replace or augment the non-performing assets such that it always provides for the obligations of the covered bond. This feature can also be considered a credit enhancement to the bond, which usually lowers the required yield on the bonds. And that brings us to our next item specified on a bond's indenture, that is, credit enhancements. Credit enhancements are provisions that can be used to reduce the credit risk of a bond issue. They're very often used when creating ABS, so we shall discuss this section in the context of ABS. There are two primary types of credit enhancements, internal and external. Internal enhancements are built into the structure of the bond issue, while external enhancements are provided by a third party. The most common forms of internal credit enhancement are subordination, over-collateralization, and reserve accounts. Subordination, also known as credit tranching, is a method where a bond issue is divided into tranches with different seniority of claims. The cash flows generated by the underlying assets first go to fulfilling the obligations of the most senior bonds, then to the next highest priority bonds, and so forth. This is sometimes referred to as waterfall structure. As in this case, if the underlying asset yields less than the expected cash flows needed to fulfill all obligations, the bonds with lowest seniority get hit first. The most senior tranches in this structure can receive very high credit ratings, and so its yield is the lowest. This is because the probability that losses will be so large that they cannot be absorbed by subordinate tranches is very low. Consequently, the subordinated tranches must have higher yields to compensate investors for the additional risk of default. Over-collateralization is the method in which the collateral pledged has a value greater than the par value of the debt issued. The additional collateral can be used to absorb losses. For example, if the principal amount of a bond issue is $10 million and the value of the collateral is $11 million, the amount of over-collateralization is $1 million. The amount of over-collateralization changes with time. For example, if property was pledged as collateral, the amount of over-collateralization will fluctuate as a result of changing valuations of the property. Reserve accounts can come in two forms, a cash reserve fund and an excess spread account. A cash reserve fund is simply a deposit of cash that can be used to absorb losses. If the cash flow from the asset is insufficient to meet the promised payments, the cash flow from the account can be used to top up the difference. With an excess spread account, the expected yield on the assets supporting the ABS is greater than the obligations on the bonds issued. This gives some protection if the yield on the assets is less than anticipated. If the assets perform as anticipated, the excess cash flow from the collateral is deposited into the excess spread account. This reserve cash can be used to retire some of the outstanding bonds in the future. External credit enhancements include surety bonds, bank guarantees, and letters of credit from financial institutions. Surety bonds are issued by insurance companies, while bank guarantees are from banks. Both of them serve the same function. They are a promise to make up any shortfall in the cash available to service the debt. So if the expected cash flow and obligation to the debt holders is $10 million, but the actual cash flow is only $7 million, the insurance company or bank will have to top up the shortfall of $3 million. A letter of credit works under similar circumstances. The difference here is that it is a promise to lend the shortfall amount to the issuing entity instead of paying out the amount. While all three of these external credit enhancements increase the credit quality of debt issues and decrease their yields, deterioration of the credit quality of the guarantor will also reduce the credit quality of the covered issue. Debt covenants are legally enforceable rules that borrowers and lenders agree on when a bond is issued. Generally, covenants are meant to protect the lender's position. The restrictions can be in the form of affirmative covenants or negative covenants. With affirmative covenants, the borrower promises to do certain things. Such covenants include requiring the borrower to make timely payments of principal and interest, maintain certain ratios such as the current, debt-to-equity and interest coverage ratios, and maintain collateral if any in working order. With negative covenants, the borrower promises to refrain from certain activities that might adversely affect its ability to repay. Such covenants include refraining from increasing dividends or repurchasing shares, restrictions on issuing more debt or debts that are more senior in rank, restrictions on engaging in mergers and acquisitions, restrictions on making speculative investments, and restrictions on asset disposals. If the borrower violates any of the covenants, technical default is said to have occurred. The bondholder can demand immediate repayment of principal. So, we now have a clearer idea of the major sections of a bond indenture and the legal considerations of a bond. Let's move on to the regulatory requirements. The applicable regulatory requirements depend on where the bond is issued and traded. Let's review how bonds can be issued globally to help us understand the applicability of requirements of different jurisdictions. A bond that is issued by a firm domiciled in a country and also traded in that country's currency is known as a domestic bond. For example, if Qantas, Australia's national airline, issues an Aussie dollar bond in the Australian market, it is classified as a domestic bond. If McDonald's issues a US dollar bond in the US market, it is a domestic bond in the US market. In this globalized world, however, corporations can choose to issue and trade bonds overseas in the currency of the trading market. These are known as foreign bonds. So, if Qantas issues a bond in the US, denominated in US dollars, it is classified as a foreign bond in the US market. In particular, foreign bonds traded in the US market are also known as Yankee bonds. Likewise, a McDonald's bond trading in Aussie dollar in the Australian market will be a foreign bond. More specifically, such bonds are termed kangaroo bonds. As we've mentioned earlier, the domestic bonds and foreign bonds that trade in a particular market are subject to the regulations of the respective countries. So, if Qantas wants to issue US dollar bonds but finds the US regulations too restrictive, does it have any alternatives? Yes, it does. The Eurobond market was created primarily to bypass regulations imposed on bond issuers and investors, particularly in the United States. Bonds issued and traded on the Eurobond market are called Eurobonds, and they are named after the currency in which they are denominated. So, Qantas can choose to issue its US dollar bonds in the Eurobond market. Specifically, such bonds are called Euro-dollar bonds. If Qantas issues them in Japanese yen, these will be called Euro-yen bonds. Do not confuse Eurobonds with the European market. Eurobonds are issued outside the jurisdiction of any country and are typically less regulated than domestic and foreign bonds. The majority of Eurobonds are issued in bearer form. Ownership of bearer bonds is evidenced simply by possessing the bonds. In contrast, most domestic and foreign bonds are registered bonds, for which ownership is recorded by name or serial number. Bearer bonds may be more attractive than registered bonds to those seeking to avoid taxes. Bonds can be issued simultaneously in the Eurobond market and in at least one domestic bond market. So if Qantas issues the same bond simultaneously in its domestic market, in the US market, and in the Eurobond market, it is known as a global bond. This can be the case for a large bond issue where the issuer wants to tap several markets to reach its capital needs. The differences among domestic bonds, foreign bonds, Eurobonds, and global bonds matter to investors. This is because these bonds are subject to different legal, regulatory, and tax requirements. Let's now discuss how bond income is taxed. The specifics of the tax rules depend very much on the applicable jurisdiction based on where the bond is issued and traded, and also the citizenship of the bondholder. We shall discuss this section in a very general manner, based on the most common applications of tax laws. For a plain vanilla bond, the interest income paid to bondholders is taxed as ordinary income at the same rate as wage and salary income. In some jurisdictions, interest income from government-related bonds are exempt from taxes. If a bond is sold prior to maturity, there may be a gain or loss relative to its purchase price. Such gains or losses are considered capital gains income rather than ordinary income. In many jurisdictions, tax rate on capital gains is lower than that for ordinary income. Things get more interesting when we examine bonds with other coupon structures. For example, a zero-coupon bond does not pay out interest explicitly. Does that mean there is no interest income tax? Bonds with no explicit interest payments are termed original issue discount bonds, or OID bonds in short. Because the gains over an OID bond's tenor as the price moves towards par value are really interest income, many tax authorities view the discount given at issuance as a form of interest payment. As such, a portion of this discount is treated as taxable interest income each year. And that concludes this lesson on the legal, regulatory, and tax considerations on fixed income securities. In our next lesson, we shall look at some of the common contingency provisions for bonds. See you again.